So Ridham, I'm just going to start putting the pieces together just for the benefit of our viewers here. Point number one, Ridham, this is a cyclical slowdown according to you. All bull markets, they go through cyclical slowdown. All earning cycles, they go through cyclicality, and we are going through a typical cyclicality within a bull market cycle. And the bull run and the earning cycle is not over. We could be 40%, we could be 50%, we could be 60%. That's only the debate. That's point number one. Point number two, you expect a lot to change on the macro front, whether it is on the GST, tax collection, interest rates, which in a sense could be the trigger point for 2025. So one has to construct the recent macro developments on the global front, the recent leg of decline in equities, assumptions that macros would be better, and government in a sense will be leaving spectrum for private sector capex to pick up. Where do you see scope for outperformance in this market, and where do you see scope of underperformance in this market? Ultimately, Ridham Desai ji sab wahi janna chahta hai. Kya lene ka, kya bechne ka?
Yeah, so I think you described it well, except that I would not even call it a cyclical slowdown, because by its very nature, cyclical slowdown is something that goes on for months. This was really a seasonal thing. It was a temporary thing. So it'll be over in weeks rather than months. But aside from that, I agree with your description of what I'm saying. Now, I think the low-hanging fruit and the hardest trade here, which is always the case with low-hanging fruit, because low-hanging fruit is the least attractive to people. People want to go for the fruit that's hanging high up the tree because it looks juicier. But the low-hanging fruit is private sector, large private sector banks. They're trading like utility stocks. Utility stocks, by the way, are trading like growth stocks. 10 years ago, the large private sector banks, the top ones used to trade at 3, 4, 5 times book. And the utility stocks were trading at 1 to 2 times book. Now utility stocks trade at 4 to 5 times book. And the private sector banks trade at 2 times book. So I think if you want to make a trade, it requires an enormous amount of patience to go through this. Because I don't know when the tide turns. Everybody is very cautious and skeptical about the banks, but that's, I think, the trade you want to put on in the market right now. So that to me is the low-hanging fruit, but it's difficult to digest this because it may not give you immediate gratification. The second place, I think, is in areas of discretionary consumption. I think the rural economy has mended. It took a little longer time than I anticipated. I would have thought the rural economy should have turned last year, but it only turned in February this year. So coming out of COVID, rural India took longer to witness the transfer of terms of trade from urban India, but that is now set. And therefore, I think consumption will actually see all-round recovery. The slowdown in urban consumption that a lot of consumer companies are complaining about, I think is temporary. Now, within consumers, though, you have to be a bit more nuanced because there are certain companies that are running into stiff competition. Their moats have been diluted, and there are other companies that have very strong moats. So, to my mind, for an investor looking to pick stocks, you have to assess the moat of that particular business. And any business that is subject to intensity of competition will not deliver the growth that you need to make money. So that's the nuance in consumer. Also, the second thing is that because India's per capita income is rising, discretionary consumption will grow much faster than staple consumption. And there are new areas of discretionary consumption, which Nikunj, you and I have been discussing over the last 2 years. And I think we are only seeing reiteration of those trends, whether it is with respect to quick commerce, whether it's respect to leisure, travel, education, entertainment. I think these areas are certainly going to grow faster than soaps and staple stuff. So that's consumption. I think in the industrial space, things have become more interesting. I was a bit more skeptical because of valuations when we last spoke. But over the last couple of months, some of these valuations have corrected quite steeply. And so there is an opportunity now that has emerged in re-engaging on industrial stocks. And the most controversial idea remains IT services. I think people are worried about the long-term impact of AI. But I think over the next 3-4 years, AI is going to be an area where IT services will likely experience a boom. as companies around the world try to build products around the AI infrastructure that has been built so far, I think Indian IT services companies will start getting a lot more orders. So I would be constructive on that space. And then I would avoid everything else. The only one that I'll add here in addition to all these, because it doesn't actually fit these four, is cement. So cement has gone through a rough time. Pricing has been under pressure. Companies are sitting at very low margins, and usually that's a good time to buy stocks. I think over the next 12 months, I won't be surprised if these margins recover quite significantly. So cement is a place that investors should look at as well. And it dovetails into the industrial boom and the capex that we are seeing on the ground.
Enviro Infra Engineers Limited now proposes an initial public offer of its equity shares. The 100% book built issue is being offered at a price band of rupees 140 to rupees 148 per equity share of face value of rupees 10 each. Issue opens on Friday, November 22nd, 2024. Issue closes on Tuesday, November 26th, 2024. For risk involved and other details, please refer to the Red Herring Prospectus, which is available on the website of the company, SEBI, stock exchanges and the BRLM, Hem Securities Limited.